Well, back in March of 2020, in my opinion, they really blatantly broke the law when it comes to the Federal Reserve Act. So the Federal Reserve Act is the the laws that confine them. I'm someone who believes that central planning isn't a good thing. And the more power the central planners have, the more you need those laws to make sure that they are constrained and that we, the general public, are being protected from them. And so I had, what they did back in March 2020, specifically buying corporate debt. And I know they did it through a special purpose vehicle and all these things, but that's you can't do that according to the Federal Reserve Act, and if not, at the very least, the spirit of the Federal Reserve Act. So that always really bothered me. And what bothered me even more is the mainstream media didn't even talk about it. CNBC, wow. Bloomberg, you never heard about the Federal Reserve blatantly going against the Federal Reserve Act. Everyone just kind of turned a blind eye, to swept it under the rug. It was like, well, it needed to be done, so I guess we can break the rules this time. And when you start having that thought, that's a slippery slope. And Janet Yellen has gone on record as saying that that could be a tool in the future, that the Fed could just buy stocks outright. And again, they're just completely ignoring the law that protects us from them and constrains them. And you might say, well, George, what's the big deal? Sure, it might be the law, but that was 1913, and shouldn't we move on? And what they're doing right now is necessary, and it's providing liquidity, and it's preventing a huge economic disaster. But what they're not seeing is the unintended consequences. So as a result, now you see that corporate debt is at an all-time high. So let's think this through. We've got we'll call it the cerveza sickness out there. We've got 15, 20 million people, Americans, that are not just unemployed, but underemployed as well. And so you've got an economy that's very, very weak and is being propped up pretty much by stimulus. If you took away the stimulus right now, I mean, I don't think anyone that would disagree that the economy would really be suffering, and you'd potentially go into a deflationary spiral. Then you look at the corporate balance sheet, and the corporations have more debt than they've ever had in their entire history. How does that work? How does that happen? And it's because the Fed has come in and they've backstopped the market, so they are a buyer of corporate debt. Well, if there's more demand for corporate debt, what does that do to interest rates? That lowers the interest rates artificially low. Therefore, all of these zombie corporations that quite frankly should have gone bust back in 2020, March, April timeframe. Now they're just loading up on debt, which they can never repay because it's so cheap. They're getting a 3 or 4% interest rate when normally they'd pay let's say a 10%, 12% interest rate. People forget how important interest rates are. They're the price of money, and they're there as some people call it, a hurdle rate, that if you've got a risky business, well, then they should be charged a higher interest rate. That's the market doing its job to make sure that they have enough cash flow and excessive cash flow to compensate for the risk of them borrowing the money in the first place. So the Fed has come in and distorted the market completely. They've created not just unintended consequences, but explicit malinvestment and misallocation of resources. And they've done that by, in my opinion, breaking the law and ignoring the Federal Reserve Act. And that was the thing that really got me fired up. And then you combine that with the fact that the media that should hold their feet to the fire just completely ignored it and has allowed them to do this. And I mean, I could go down a laundry list of things the Fed has done over the last 20 years that has made the middle class, the poor and middle class, a lot worse off. I mean, we could start by devaluing the dollar. I know that since the Fed was created in 1913, the dollar has lost over 97% of its purchasing power. And you say, well, that might not be a big deal because wages have gone up. Yeah, but wages always lag the rate of inflation. And if you really think these things through, what it does is it turns our entire society into speculators, to where you have to gamble, you have to go into the stock market, you have to do these things in order just to maintain the purchasing power of your savings. Where if the Fed wasn't doing this, we'd have strong money. We'd have a almost deflationary money in the standpoint that a free market always wants prices going down because there's entrepreneurs creating things at better prices more efficiently. Well, that's a benefit to the average consumer, you see. But we've lost all of that because the Fed, I mean, they're not even doing it implicitly. They're doing it explicitly now, saying we want the consumer to lose 2% of their purchasing power every single year. And now they're saying that if it goes above 2%, maybe 3%, 4%, 5%, they're just going to quote unquote let it run hot. Well, what is let it run hot? In other words, they're going to allow the average Joe and Jane to lose 5%, let's call it, of their purchasing power every single year, and they're not going to do anything about it. In fact, they're trying to create this environment. They're not trying to prevent it. And so again, if they're doing it abiding by the law, that's one thing, but they're doing this by blatantly breaking the law, and no one is standing up and saying, hey, the emperor has no clothes. And that's why I felt it was necessary to kind of take action. So there's one type of deflation that decreases demand, and that happens in a society that's over leveraged, right? But if you don't have that, then let's go back to the late 1800s in the United States. And most people have never really done the research on this, but if you look at the prices in the United States from 1800 to 1900, so 100 years, prices actually went down by 50%. So I've done some research on the late 1800s specifically. And during that time frame, you had deflation of about 2 or 3% per year. We had free banking. So that doesn't mean that your checking account is free. That means that it's free of any government intervention or a central bank. So back then, banks would literally print their own currency in some areas. And so you had a check and balance there where there were no bailouts. So if the bank did something bad, they would just lose everything. So they are incentivized to make prudent loans. Well, if you're making prudent loans, you're lending not for consumption, but you're lending for production, to the creation of more goods and services. And that's deflationary. But when you get that type of deflation, you have wages actually going up in nominal terms. And per capita GDP actually went up in nominal terms, while the price of the stuff the average Joe and Jane buys daily goes down.